What's going on, guys? Tristan Clunis here, and welcome to the Tristan Clunis Show. I am, of course, your host, and where we talk about all things real estate related. So we talk about real estate, and we get into finances and all kinds of stuff. So I'm trying to be more consistent, guys. This year is about consistency. I fell off for a few months, so I'm just trying to get right back into the flow of things. We had Chris Slydom, which is the broker of record for Royal LePage Signature last month, and he killed it. Please go down below. You'll see the link. Nick, I'm giving you more work. You'll see the link down below. But we have a great guest today. We're going to be talking about a lot of things related, not necessarily related to mortgages, but in terms of, qualifying and all these things that I've been getting a lot of questions lately. Let's just say that. I've been getting a lot of questions from viewers, clients, friends about where they see things going for this new year for 2024 and how they can afford to buy a home, whether it's the first or move up. So we're gonna get into that. I have none other than Zac Lofeudo. Did I nail the last name? Hey,
first try.
Zac Lofeudo. So I have Zac Lofeudo from BRX Mortgages here. How you doing, my man?
Good, man. Thanks for having me.
No problem. He's a mortgage broker. I have a lot of questions, man.
Good.
First things first. How'd you get into this business? Let's get.
Oh man,
tell me about yourself.
There's a whole origin story. I'll give you the quick Coles notes of it. But I actually came from the restaurant industry. I owned a restaurant for about 5 years in the east end of Toronto. Wanted to get into a different business where I could use some transferable skills, running a business, being self-employed, being able to talk to people, schmooze away, and then kind of take that side of the business, but doing something different, right? So I actually was going to get my real estate license. I was going to become a realtor.
What happened?
And I was about 2 courses through is when they switched over to Humber. I ended up meeting a top mortgage broker in Canada, and he's like, "Don't become a realtor. That's awful." Oh, sorry, I don't know if we're supposed to swear. Fair enough, but that's
Nick will do whatever he has to do. Fair enough.
That's how it was, and I was like, okay, I'll try out this mortgage thing, and then kind of took a little bit to get going, like everyone in kind of any of these styles of business, right? But once I kind of started getting the ball rolling, found my niche, found my clients, found who I was looking for, client avatar, all that sort of thing.
Yeah.
Just kept going from there.
And you mentioned your niche. Like, what is your niche? What do you focus on?
So right now, it's shifted throughout I've been doing this for about 4 years now, coming up on my 4th year anniversary. So it's shifted throughout the years, but now sort of the last 18 months or so focusing on the kind of first-time investor.
Okay.
First-time home buyers I've always worked with tons of first-time home buyers. They always just come into my sphere through my network, through other referral partners, etc. But the first-time investor niche is kind of what I've figured out, different strategies, ways to pay off your mortgage faster. I think we're going to get into a couple of those and got some questions on. So that's sort of what I've been finding is the best, or I can resonate with, or I can teach and handhold those types of clients throughout that process, or people that already have maybe one investment property and they're looking to grow, or they're just happy with just having one investment property and optimizing all of their debt. And that's kind of where I found I've come into a good world in that sense.
It's funny because I find that my clients, so I've been doing this I'm going on 12 years. And I find that a lot of my clients they're getting into that place where they bought their first home. My first year was struggling, trying to figure it out. My first few years, they bought their home. A couple of them have already bought second or third home, but a lot of them are in a position where they now have equity. Yep. They bought it 5, 6, 7 years ago. They want to tap, but they don't know how to, and they're very much afraid of this market right now. So what kind of conversations are you having with them?
So that's exactly what I found. So I've created a whole, it's called Strategy Hub that I have online, and we can put some links so people can go check it out and everything down below.
That's all you.
But that is what I kind of created or started creating content for those people that are afraid or just don't know what to do. What's going on with interest rates? Should I buy now? Should I wait? Should I not tap into my equity? Should I pay my mortgage off? Should I take out all my equity and invest somewhere else? Should I top up my mortgage? Should I refinance? There's so many questions and there are so many variables, and it does depend on that particular person's 5, 10, 15, 20-year plan, right? Do they have younger kids? Maybe buying an investment property to kind of fund your children's education in the future, maybe instead of investing in RESPs, or doing both.
How do you do that?
Kind of diversifying. So that's exactly it. One of my strategies is looking at trying to do an apples to apples comparison of investing in RESPs, where the government will top up your contribution into an education savings plan, for your children. But there's limiting factors on that. They have to use that money for going to a secondary education, right? What if a lot of people aren't going that route now when they grow up. Maybe they want to start a business. Maybe they just want a place to live and they just want that money or that tap into that, equity in your home. So buying an investment property instead, or doing both. I'm not saying RESPs are bad. I'm not saying taking a safer investment route is obviously going to be sort of a guaranteed thing for sure. But buying an investment property by tapping into that equity that they might have increased over the last 5, 10, 15 years, like you were saying, people that bought 10 years ago or so with you or your first couple clients, right? Utilizing that equity for a down payment to buy that investment property and then just holding it, right? Holding it 15, 20 years when you have a 0 to 5-year-old child, by the time they're going to university, now you've got all this equity built up here, your mortgage is being paid down by the tenant, your mortgage is paid down on your primary residence, and we're able to also take more tax advantages from having an investment property as well.
That's literally what my wife and I plan on doing. So we just bought a new construction, a pre-con with that in mind. And of course, I know everybody's like, oh my God, pre-con. We're gonna get into that at a later time. Sure. But the whole idea for us is not like to sell it in the next 5 years. We're trying to hold on to that for a while. That's his unit. We're gonna use that alongside RESP because I think that's important to do it. It's just that, as you said, like it's not your end all be all. There's other ways of
exactly, and
of
it's
course,
diversifying at the end of the day, right? And diversifying your investment. That's why you're going with the pre-con route. You could do a resale and get a tenant right away, but you want that appreciation growth while it's being built, 100%. As well as putting money in the RESP. Like doing a little bit everything is going to be, and especially if you're holding it for 15 years, you're not trying to flip it. You're not trying to make a quick profit. It's a long-term game. Real estate is in general. Right?
What have you seen? Because even just with that, the difference between flipping, people that are flipping, the clients that come in, your way, flipping homes or even assignments, which we could talk about at a later time as well. Yeah. Like, what have you seen as the differences between holding long-term versus short-term?
I generally don't work with as many clients that are flipping. I know this market has obviously been more difficult for people that were, especially in that time when where the house prices all over Canada started to drop aggressively. Right. So then they kind of were trying to walk away with a break even or a loss or get out of some properties because you're buying a property for an inflated value and it drops even though you increase the value by 200 grand. Well, it dropped by 220. You're just trying to get out of there and try and break even or kind of just move on to the next project potentially, right? So I don't deal as much with flippers because I try and find that client avatar that I was kind of talking about, that first-time investor or someone who has one investment property and I want to plan out a 10, 15, 20, 25-year goal, right? A lot of what I do as well is, and we can jump into this now if you want to talk about it.
Let's go, man. We're going with it, man.
All right,
we're just flowing, lots of
the rental cash damming. So I know you had a question.
For those that are watching, I know a lot of people are going to be like, rental cash damming. What does that mean? What is rental cash damming?
This strategy has been around for 20 plus years in Canada and not many people are talking about it. Not many people know about it. You've been in the game for 12 years, like you said, in real estate, and you're like, what the heck is this?
The term, so I'm hoping to hear something like where it's like, okay, I know this because it was called something different or whatever the situation is, but the term, when I saw it, because he has great social as well, where you're giving knowledge.
Up, down,
again, Nick, our producer Nick is going to take care of that, but you're giving a lot of knowledge on things like those type of strategies. Rental cash damming, explain it, please.
So the base, I'll try and do the Coles notes, and then we'll dive into a little bit more of the specifics. So essentially, you're making your non-tax deductible debt into tax-deductible debt.
Okay.
So when you use debt in Canada to invest, like buying an investment property, right, you can write off the interest portion of that mortgage, right? So that's tax-deductible debt. That's true good debt.
Right.
When you buy yourself an owner-occupied home, your primary residence, the house that you live in, you can't write off that debt. So even though you use debt to buy an asset, it's not necessarily good debt because you still can't write off that interest portion. Using rental cash damming, we're converting that primary residence, that mortgage payment that you cannot write off that's non-tax deductible, and making that mortgage into tax deductible debt. So how we do this is the process. Most people, when you have an investment property, right, you take your rental income that you have and you pay your expenses. Maybe you have like one bank account, the rent goes in, the mortgage payment comes out of that account, maybe the property taxes,
whatever expenses, water, whatever.
You just keep doing it like that. The process behind cash damming is we're just moving the money around a little bit differently, and we're borrowing money from ourselves as well. So how we do this is we have the rental income, the rental property. you have your owner-occupied mortgage.
Yes.
Instead of taking that rent and paying the expenses on the rental, you take the rent from that rental property and you double up the mortgage payments on your primary residence.
On your principal residence.
So let's just make it easy numbers, $3,000 rent, $3,000 mortgage payment you have on your primary.
Yeah.
You're actually going to make a $6,000 a month mortgage payment on your primary every month. But then you're thinking, okay, well, how do I pay all the mortgage and the expenses and everything?
Those exist. Those expenses are still there. Gotcha. Yeah.
So you had now set up, and you have to have the equity to be able to do this. Not everybody qualifies for this as well, but most people can if they've built up or they've had their property for a little bit.
Okay.
We add a readvanceable line of credit as well onto a home equity line of credit onto your primary.
Okay.
So now those expenses on the rental, you're actually going to borrow from that home equity line of credit to make all the expenses. Now, once you've done that, you're using that money to invest. You're using it for the investment purposes.
So now
all that interest is now tax deductible, and you're paying off your primary or that principal balance on your mortgage super fast because that $3,000 that we doubled up, that goes right to principal. So how does interest?
So how does that change the person's amortization? Like, how does that work?
It speeds. So doing this process correctly, you are going to shave off any. It's going to depend totally on where the mortgage amount is and how much their tax bracket as well. There's lots of other kind of little factors in this, and when we put together a whole procedure for someone, it goes into more specifics. But it can shave off. The one I just did for a client like a month ago, shave 13 years off of their amortization. And we're not putting extra money into anything. Yeah. So it's like we're not doing a strategy that you'll see like pay an extra $500 per month on your mortgage and you'll pay it off 6 years faster or whatever,
13 years.
13 years.
Gone.
Yeah. So from 26-year amortization down to 13.
And obviously depending on where your mortgage, when you start the process, where your mortgage is.
Exactly. So we just started it right away, set up the right mortgage payments, set up the readvanceable line of credit. Obviously they had about 50% loan to value. They had equity in their home, so we were able to set up that proper mortgage product that they needed. But as soon as we started doing that, it aggressively pays it down. And you're also getting that tax refund every year, right? If you're a salaried employee, if you're self-employed, you're going to get like a discount basically off of the tax you're going to pay. It's going to go off of what you should pay at the end of the year for your taxes. If you're salaried, you're actually going to get big tax returns from all of that interest that you can now write off that's tax deductible. So you can take those lump sum payments as well and start paying your mortgage down even faster. So that's why it just expedites the pay down of your mortgage as well as getting you taxable benefits. So you're saving a crap ton of money.
So are you saying that should be the strategy? So and when you were referring to paying down your mortgage for your principal residence, that's the strategy that you're referring to as well. Like that's kind of mixed in.
That's exactly it. It's like if you have an investment property right now and you're not doing this, you need to do it. If you have a primary residence with a bunch of equity, you should look into buying that investment property to be able to do this.
Right? I haven't heard a lot of people doing that, to be honest with you.
Yeah, and like I said, the strategy's out there. It's been around. It's in a CRA handbook from 2003.
Why isn't it being why aren't people taking advantage
honestly,
of it?
I don't know. I feel like it's going to come out more. Like it was
after
it was
this.
Done a lot.
Once this has 1 million views,
exactly, and you're going to be finding all the investment properties in Canada for people.
Well, we got you. They'll bring them to you. I'll bring them to you.
Yeah. So man, I think it's getting out there a little bit more. A lot of people have done this in something called the Smith maneuver. If you've kind of heard of that.
I've heard of that, yes.
So that's the same principle in theory, essentially, but you just use your owner-occupied mortgage as a tool to invest in more traditional stocks or bonds or GIC, wherever you want to put it, where you get any type of return. But you're doing the same thing. You're paying down your principal, and as that principal goes down, you re-borrow that same money right from a line of credit right away.
Right.
So then you're doing the same process because now it's tax deductible. Now you're putting money into another asset that's growing. That's sort of the same theory, but you're not using an investment property to do so as well, right?
Do you find that when you have these conversations with like your clients that they're kind of like, sounds risky, I don't know what
100%, and it's like, there obviously is risk in any investment. I don't over exaggerate sort of the numbers. When we put together calculators, I use like even a 2 or 3% appreciation on the property.
So you're conservative.
I use like a 1.5% like growth for the rental income that's coming in. Like very conservative numbers. And even when we do that, the numbers are crazy. Like even
with those conservative 1 and 2%.
Even those conservative, we're still paying your mortgage off faster. We're still getting the taxable benefits. We're still shaving years and years off of that mortgage. And so then if we put in the numbers that are like the average over the last 40 years, and we actually jump it up to 4, 5, 6% or whatever, it gets even crazier. But I want to be more conservative. So that's kind of mitigates that risk factor for
they can
people.
kind of breathe a little bit
Yeah, because I'm
easier.
like, look, even if the worst case scenario we see at 2% appreciation, I could do it at 0% appreciation, and we're still going to come out ahead,
still work.
right? So it's like even if that property 15 years later was worth $500,000 when you bought it, $500,000 15 years later, you're still going to come out ahead because we're able to use that cycle of creating tax-deductible debt.
And what kind of qualifying? Like, what are the qualifications for something like that? I know obviously you need equity in your principal residence.
Yeah, so ideally you want to have, you want to be at like a 65% loan to value on all of this, because that's when the readvanceable line of credit is going to work for you. As you pay it down, it grows. Anything above that, it's going to be hard. We can still do it.
Gets a little tricky though.
But we'll just have to maybe move some stuff around. It's still possible. But basically you just need to have the equity available. You need to have the down payment. So you either need to be able to borrow that money from the equity in your home to buy an investment property if you don't already have, or if you have other savings or whatever, you can use that as the down payment. And you have to be able to qualify, right? Like, it's not everybody's going to be able to do this for sure, but the chances are people that have had their home for maybe 5 to 10 years right now, they're probably in the pocket where they can start to look at this at least. Start having the conversation, see if it's feasible. You can also buy property, anywhere in Canada, and this works. So it's not just a specific, like, you have to go buy a condo in the GTA and it's not going to cash flow, and it's not like you could consider buying a $200,000 condo in Alberta or something and still use the same system. It doesn't have to be kind of in your backyard. So even if you maybe don't qualify to buy, another $1 million GTA property and
minimum.
And still, exactly, right? So even if you don't qualify for that, there's still options where we can start this cycle and get creative on where we can do this. Right?
And just because you touched on buying a condo in Alberta, do you recommend like your clients going elsewhere outside of the GTA? Honestly, if you can't afford it?
If the numbers work, like that's why I like working with these first time investors as well, because there's no emotion with the purchase, right? And it's easier for you as the realtor too. It's like, we don't, the light switches aren't in the right place, and this, it doesn't
whereas
matter.
Whereas when they're first buying their home, literally the light switch will be a deal breaker.
Exactly.
So they can kind of like separate themselves.
So this is just strictly, if the numbers work, the numbers work, and that's why I say, it doesn't have to be something that you buy in your backyard or anywhere or anywhere close to you. You can look at anywhere, and if the numbers work, the numbers work, right?
Question for you. So, even just staying on the topic of investing, I've received a lot of questions about people like wanting, I can't qualify. I just can't qualify by myself. I don't have the income. Like, income is obviously huge right now with the stress tests. They're having to qualify at a way higher rate. It's harder and harder, as you said, right? Unless you're going to buy something that's for like $200,000, $300,000, which is
exactly
not possible in the GTA.
Edmonton, but
right, exactly. Now we're going back to Alberta. So my question is, are you like pushing, or would you recommend people getting in with friends? So with friends or family members, what are the pros and cons of somebody doing that?
Yeah, I mean the cons would be, you're going into an investment with someone. So, but obviously you're going to sign contracts. You're going to make sure everything is on the up and up. The lawyers are going to, divide the shared ownership and everything like that. You can put all those safeguards in place, but you're buying with someone else. Like, what if they all of a sudden they need the money and they want to sell the property, and then you don't want to sell it? You're holding, like, there could be that division down the line. So you really have to have clear goals that align with those people, right? Because maybe if you are buying with friends, it's a great way to just get in the market in general. If we want to jump into just sort of like first-time home buyer, doing something like buying a duplex with, a friend or a family member or whoever, and then living in each one of the units as they then wait, again, 5 years goes by, the equity goes up, you sell it, now you both have a nice down payment.
Go your separate ways,
right? But that has to be clear and the goal, because what if someone gets married or has a girlfriend now, or they want to expedite that timeline. Now it's 3 years. Well, the other buddy doesn't want to go for 5. Like, that's where it can get potentially complicated down the line. But life happens, and life's complicated. So that can always be a problem with anything. With if you buy by yourself or buy with people. So, but I think in terms of adding more income to a file, combining down payments so that you can get into the market faster, fantastic idea. Same with buying an investment. If we go back to it being like non-emotional, right? If you're just like, we want to buy this investment, we want to hold it for 15 years, this is the plan, we can't qualify alone, but together we can, and we can maybe pull equity from our homes each, or we have the savings to buy that investment property. Great, fantastic idea, right? I think that is a great plan.
Yeah, like I just want to talk to the camera for 2 seconds. That is the biggest thing for me, where I'm like, I'm having conversations with people. I'm like, look, as long as you have contracts in place, have contracts in place, clear goals, everything in writing, signed, like make it ironclad so that everybody's on the same page. Because one of the things I did run into over the years, people, even, and not just with like friends, actually even just being boyfriend and girlfriend. Like I've seen situations where boyfriend and girlfriend, oh my God, we are in love. We love each other forever and ever. And then they buy a place. Within a few months, they're like, this is not working out.
I've had some clients where I'm like, I don't know if this is a good idea.
Yeah. After
I've been having
seeing their situation?
I talk to each other on the phone or having the Zoom calls, and I'm like, I don't know, maybe we should. I'm like, I'll do it if this is your plan.
If this is what the plan is.
I'll help you get there. But
Correct.
I'm like, in the back of my mind, I'm like, maybe they should wait a little bit.
Yes,
on this.
and that's exactly. So my whole thing is just make sure, because even I always get, when I see boyfriend and girlfriend, even that, like I always kind of get like, okay.
And you have to be more of the therapist.
Yeah, it's challenging.
So for me, I can stay on the sidelines, do the numbers.
I always tell them, like, look, just know, like, it gets messy. If you guys decide to go your separate ways, I mean, and the market tanks, or whatever the case may be, or one doesn't want to sell and the other wants to sell, like, it gets tricky. So, like, that is the only issue. What about the pros? Obviously, talk about the pros, which you kind of touched on. You said, like, I mean, the qualifying pros, obviously would be a big one.
Qualifying much easier. You've got dual income on there. You got dual down payments. You've got if one's credit is maybe not as great and the other person is excellent, that's going to help boost the file. Now you can help kind of pull your other person up, right? You're building up that equity, right? So you can then eventually go buy your own properties or property or whatever that may be. You're getting in the market way sooner. So if the market, I know we're sideways or down, upside, everywhere right now.
What this is.
Yeah, I don't like to play the prediction game at all. But if history repeats itself and the market starts to go back up, price starts to go back up. Yeah. Buying now with someone else, getting in now and riding that appreciation wave instead of waiting for X amount of time and then you're just buying a property at a higher price point, right? By yourself. You'll never get there without getting into the market with someone. Else. So those are tons
and then,
of pros.
And you said it, like, I mean, at the end of the day, 5-6 years down the line, especially if you were able to, in real estate, especially, let's even say 10 years is a long time. Yeah. But we've seen 10 years in the market, your property almost doubles every 10 years.
Yeah, exactly.
You know what I mean?
That's when you're looking into the now maybe investment property and the rental cash damming and all that. Now you can go get crazy in advance and get into that fun stuff.
Or go separate, or go your separate ways. Take your income, you guys sell it, or you pay the person out and you take your money and go buy your own place.
And it's owner-occupied home, so there's no capital gains on that. It's just like you're just walking away with whatever that cash is going in your pocket. So maybe you want to take off and just go live in Costa Rica with your nice and all that.
That sounds awesome, man. That sounds great, bro. That's amazing.
Exactly.
Okay, so I have a question. We obviously we're talking about investing, new construction. Mm-hmm. A lot of people got into the pre-con. Yeah. They bought these pre-construction projects, years ago. Yeah. Obviously, interest rates have skyrocket compared to 2021, 2020 when you're probably buying it and your interest rates are at 2%, 1.5%.
Yeah.
1. Yes, I see
0.99.
Even lower. Yeah, I saw 0.99, which is insane. Exactly. And now you're seeing 6 plus, easily.
I always say this when this topic comes up. I think pre-construction and getting a pre-approval on pre-construction is just so stupid.
It's the dumbest thing in life.
Because
and it's only 3 months. They only want 3 months.
Yeah, they just get the piece of paper that means nothing. That doesn't mean so many things can change in your life in 5 years.
Everything can change. Everything. You can get married. You can get divorced. Somebody can pass away, unfortunately.
Exactly. You could lose all your money gambling. You could do whatever.
Exactly.
So There's so many things.
No worries. So my question is in those situations, what are you finding right now? Are you seeing?
I'm seeing a lot of people either just qualifying, just by the skin of their teeth, and we finagle some things to get done, or the value is just way down and they can't close on it, or we have to go with alternative lending routes, which will. A lot of the time, A lenders and big banks will lend on the value that you've bought the home at. So if it's dropped and the appraisal gets done, they're not going to finance that money. You need to come up with that extra money.
Right.
We can potentially with alternative lending and different options. I've seen some people get kind of creative on how we can sort of get that done still for them.
It's expensive.
It's going to be more expensive. You're going to have potentially fees in there if you go alternative or private or all sorts of stuff that's going to end up costing you more money. So sometimes you look at the numbers and you go, it actually may be more lucrative to walk away from a deposit, which you're seeing out there. Lots of people are just like walking away from 100, 200,000 I've seen out there in articles and things like that. So it's tough. Sometimes there is like no option, or the best option is to walk away rather than paying all this like inflated costs.
How do you avoid that? Like, so how does one, like I as I said, I buy pre-construction. I know that there's risk.
That's the risk, right? Like that's the risk in investing. And I think because like pre-construction was going crazy and interest rates are super low and all these projects, there were just projects after projects. Everyone's like pre-con, platinum, got access to this, like everything was popping up. I think it was so hot and like shiny object, right? And everyone was like, yeah, this is great, but not enough where people were talking about the risks.
Right.
So it's like anything, buying an investment property, doing rental cash damming, doing whatever, everything that we've talked about so far, all have their calculated risks, right? And to mitigate those risks, you can do certain things. Unfortunately, with pre-con, you're at the whim of the market and interest rates because you're just holding you bought a piece of paper for that time being, right? There's no property yet, it's being built, so you have a piece of paper worth $500,000, $600,000, $700,000, whatever it is. But if that goes up and down, that's the risk, right? Like there's nothing you can really do to control the market or what's happening while you're waiting for the property to be finished.
And the challenge that I have is the people that were, like, I had a few clients that called me, you know what, just should I want to buy this pre-construction, but I don't plan on closing on it. This is when the market was amazing, by the way. This is when it was like 2020, 2021.
On that too, right?
They're like, I'm not planning on closing on it. I have this money.
I'm going to sell
I have
the assignment.
I have $120,000 ready to go. I could just put that down as a deposit, and then right before I'm supposed to close, I can easily just assign it and make a couple $100,000. A lot of those people are
and that's the same thing. They weren't looking at any of the risk side of things.
I always I tell my clients, look, even if that's a strategy, which I don't recommend at all, to assign, I personally do not recommend it. But if that's the strategy, have the plan to close or be in a position to close.
Be able to close. Don't get
just
that fake
in case.
Pre-approval that says, oh yeah, you're good to go.
Exactly.
Here's the stamp and here's your deposit and see you later. Yeah, you definitely should have. That's like number one for sure. Have a plan to actually be able to do it, because then you're really screwed if you come to that closing table. No one wants to buy your assignment. That's happening. The value's dropped.
Well, that's
and
what we've been seeing.
Close,
well, I've been seeing that left, right, and center. Assignments are coming up left, right, and center. People are assigning their properties for less than what they even paid. Like literally, just like, look, I'll walk away. I just
100%.
I'll give you half of my deposit. Like, just get me out of this situation.
Yeah.
And it all seems amazing.
And I think a lot of people also don't realize, just to touch on this quickly, like the timeline of like getting a mortgage on a pre-construction property. I was talking about this with a couple people actually the other day, because they didn't know, like, when do I pay the bank? When does everything? When does that timeline happen? So it's when you put the deposit down. Yes, you bought essentially the piece of paper or the land in the sky of when it's going to be done. Then it comes up to occupancy phase, right? And the occupancy phase, a lot of people think that's when they're getting a mortgage.
They're going to close.
Yeah, but no.
You get keys in your hand.
Yeah, you can move in, or you can put the tenant in there, depending on the terms, whatever. But now you're just paying rent to the builder, right? And then you have to wait until the registration date. The registration is when you actually obtain that mortgage, right? So I just like to clarify, whenever I'm talking pre-construction, it's a good thing to kind of put in there, because a lot of people don't know that, of like that timeline. And registration, they're generally going to give you 30 days notice. So you want to be in a position ready to go. You want to be ready before that, right? Maybe 60, 90 days out, you can kind of guess or get some sort of word that the registration will be coming up. Get all your ducks in a row there, make sure you're good, so that we get that notice at 30 days, we just hit the button and
ready to
finalize
rock.
It. Yeah, that's it.
Question for you. So on the mortgage side, like, are you telling your clients right now, like, that are looking to buy, variable? Are you telling them, like, look, go fix for a short period of time?
The age-old question.
Well, but it's so much more important now than ever before, because we obviously 100%. Have no idea. We're hearing that they're going to be dropping rates. Exactly. Nobody knows when.
I hate to play the prediction game. I don't. I think it's just going to be a longer plateau than people think.
Whereas
people thought, we were going to see a cut maybe in, as soon as next
April.
month.
We were hearing March, right? April. Yeah,
exactly. But
I don't think that's going to happen.
I think it's going to be a longer plateau before they start to cut. Even when they do, it's going to be incremental, right? Quarter point cuts. That's That's what the people are saying. That's what they're saying. Because they were saying that it's going to be 100 basis point by the end of the year. So by December's announcement, it'll be a quarter. If that happens, that's what I'm telling people. Variable is looking more attractive now because you're going to be riding the wave down instead of riding the wave up.
Correct.
Right? And you can still get an okay discount off of prime, which is basically what your variable rate is based on, right? It's like the prime rate minus blank. That's what your actual variable rate is.
Yep.
So I'm seeing people right now, I'm like, you can bet on it. If you're more of a risk-adverse person, take the short-term fixed because it's just guaranteed.
And short-term what, 2-3 years?
Yeah, 2 or 3 year. 3 years is going to have a more attractive interest rate right now. That's where most people are kind of settling on that 3-year fixed rate. I call it sleep insurance. If you're not a person, if you want to just go to bed at night and know that nothing's changing, you have to worry about the articles that are happening, you have to worry about the Bank of Canada announcements, who cares? Just that's your interest rate in 3 years.
Yep.
Hopefully rates are going to be in a better position.
Right.
We revisit it then.
Right.
That's it, right? Variable, if you are more of a risk taker or you want to kind of bet on the Bank of Canada actually making those cuts or doing what they say they're going to do, which is historically and over the last 2 years not a good thing to bet on.
Over the last, you're right, 24 months, you're right.
They literally
terrible.
said that rates were going to start going up as of like last month.
Yeah.
Like that was their original timeline. End of 2023, we're going to start increasing interest rates.
Well, I mean, if we even go back, if we go back to like beginning of 2023, they were saying like, look, we're done. We're done increasing interest rates. We're going to keep the rates the same.
Exactly.
Then the market went crazy, and then they decided to
we
start.
saw that like May, June time of year
nuts.
where the actual average home in Canada went from, I think it was 800,000 at the start of the year for all of Canada, and then it dropped down to like 600,000. So we saw a 200,000 decrease in that 1 month where they said we're going to stop. It went up 100,000, went to 716,000 or something in the middle of the year.
Some areas 150,000.
Exactly, right? So that's crazy. Just from the word of, we're going to stop. And fixed rates did drop a little bit. They dropped by about 0.75, 1% in that time frame. We saw a nice little dip there into the 4% range and stuff like that for a little tiny bit. That's what caused that spike as well.
Right.
But we're potentially seeing that now, right? Fixed rates have kind of been going up and down with the bond market right now. The rumblings of the variable, right? So we could see that same thing happen to the market into 2023 or 2024.
We will see. We will see. We'll see. I have a couple more questions, and then so I want to know the. So you mentioned the strategy of paying off your home sooner, which I love. Rental damming. This just to clear it up.
Yeah.
In the U.S., people talk about there's some no money down. Purchasing or ways of buying homes. Does that exist? That's just
technically we have like
in Canada.
In Canada, technically we have like what's called like flex down mortgages, which are basically you can borrow your debt. So it wouldn't be no money down at all, but technically no money from your pocket. You could have like a line of credit, borrow that money from the line of credit, used for a down payment. Lenders still like to see that you have some money though.
Some skin in the game.
Yeah, exactly. So yes, and that's going to be extremely hard to qualify because then we have to debt service that line of credit or wherever you're borrowing the money from. That's going to take away from your qualifying mortgage amount. So then we have to service all of those other debts, right? That's what goes into getting a mortgage. So technically, yes, there are out there.
Okay.
Are you going to qualify probably as a first-time home buyer? Likely not, because you're probably starting your career, have like a lower income, and you're going to work your way up. You may have just a little bit of money, so borrowing money and then also finding a home, especially in the GTA, and qualifying for that $500,000-$600,000 condo minimum, you're probably not going to get away with that flex down. But
so just you touched on first-time buyers just now. Last question for you. What are your top, you can say 3 or 5 programs for first-time buyers that you would recommend that they should get involved in right now?
Right now, if you're planning to buy anytime in the next 15 years, take advantage of the First Home Savings Account, that new account that was started last year. Put some money into it. It's tax-free. It grows as well. You're going to get a tax rebate. If you're in a medium to high tax bracket, just by putting the $8,000 in the year, you're going to get a $2,500-ish rebate on your taxes. Then there you go. Add that to the account as well, right? So there's number one, FHSA. RSPs as well. If you don't have money in there, you're going to also get a taxable rebate. So then that's going to give you a tax return. Add that to your down payment. So take advantage of those 2 accounts, right? 100% right away. If you're a couple, right, you can both put up to 35 or pull 35,000 from your RSPs.
Separate accounts?
Yeah, you can both have them. So you can technically both use an FHSA, that's a mouthful, and an RSP.
We understand.
So both of you could take advantage of both of those accounts right away. Gotcha. So if you have the money, if you're not doing that, it's free taxable money, right? Like get the free money from the government. Why the heck not, right?
Why the hell
do it? A couple things that are just automatically going to be applied to as a first-time home buyer: rebate on your land transfer tax.
Nice.
That's really the biggest benefit to being a first-time home buyer. There's the incentive where the government will gift you some down payment towards your property. not many people actually use it. The government then owns a piece of your property.
Yeah, and I haven't heard a lot of people taking advantage of it. Why not?
Not many people do because it's not as like lucrative or beneficial really for the person, right? Like for the person using that program, you have to repay the amount of money plus any appreciation, whatever that percentage of appreciation is. You also have to pay that back to the government when you sell or when you move or after 25 years, right? So, and really all it's doing is not really even helping you qualify for that much more likely, and it's really just lowering your monthly payment probably by like a couple $100. Right. So it's like a $200 a month saving.
It's not worth it.
Is it worth? You can do the math and say, okay, if I'm going to be here for 7 years and I'm saving this much, $200 a month, this like it can be worth it.
Right.
But like utilizing the program, most people aren't really going to need it or going to see too much of a benefit from actually using it. So that's the big one that's out there, but not many people use. The rebate off land transfer tax is going to be automatically applied.
Which is nice.
So, and in Toronto, you get hit with that double land transfer tax. So you're going to get up to $84.50 off of that land transfer tax. Immediately on closing costs, the lawyer is going to put that into your statement of adjustments at the end, and you just pay less land transfer, which is fantastic. You also get a rebate on your taxes for that year. So you'll get $1,500 back as well. You just have to let your accountant know that you bought a property in that year. So you just have to make sure that you file that on your taxes. And those are kind of the first-time home buyer benefits.
Dope.
Out there. Yeah,
that's buddy. It's been awesome.
Yeah. All right.
Lots in there. To be honest with you, we were like, what? How long is this? Like 30-something minutes?
38.
Yeah, like you went through everything.
Keep going.
I have a question for you.
Yeah.
Is there anything else that I'd even touch on that you think that people should know?
Maybe one more quick, just that ties into that first-time home buyer, like
Go ahead, man.
kind of a creative way that I've been talking to more people about is, we always say like the bank of mom and dad or parents trying to help them, gift them a down payment. But a lot of people may be equity rich, like their parents might have a little mortgage or no mortgage at all, so they have all that equity. But they want to help their kids buy a house, but they don't want to maybe get a traditional mortgage. They don't want to refinance because then they have monthly payments.
Are you gonna say the reverse mortgage?
Do the reverse mortgage.
Tell me. So we've been here over the years.
It's becoming more and more popular.
Definitely becoming more popular.
There's lots of ways to utilize it. This is just one way for first-time home buyers. So if their parents have all that equity, they don't want to have a monthly payment. A reverse mortgage is basically just a no monthly payment loan. It still has you still get interest, but it just gets added on to the principal amount of the mortgage every month. So there's nothing out of pocket that they're paying.
It's not affecting your pension or whatever money that you have coming in.
And you need all you have to do is show that you can basically pay your property taxes, and you're 55 and older are the stipulations. The older you are, the more money they're going to allow you to take out as well, because you either repay it when you sell or when you die, basically, or when they pass away, then their heirs or their kids or whatever, they can take it over with a regular mortgage, or if they're old enough, a reverse mortgage in someone else's name, right? So there's lots of ways they can do that, but that's getting more technical on the reverse mortgage side. I've just done this now in the past, even like couple months, brought this up to a few different clients of like, well, talk to your parents. I know they want to help you. Right. They don't have cash for that down payment.
But
they
don't
want a mortgage, but they've got that equity.
Right.
Let's have a conversation about using a reverse mortgage to gift you those funds. And if we want to get even more technical into the investing side, not first-time home buyer, maybe you have young kids. There's a callback full circle here from earlier and what we were talking about. Maybe they want to help their grandkids out. Use a reverse mortgage to gift them the money for a down payment to buy an investment property that they can use for their kids' education in the future, and we can also start rental cash damming. So we can just circle everything full circle all back around.
You just put a nice little bow on that, man. That's awesome, man.
All right,
Zach, thank you so much, guys. I hope you enjoyed this podcast interview. I learned a lot. To be honest with you, sitting here with Zach, I learned a ton, which has been amazing. Please make sure you like, subscribe, comment down below. Let me know if there's any other topics that you want to touch on. It doesn't have to necessarily be real estate related. It could be finances or entrepreneurship, whatever you have. Anyways, Zach, I appreciate you coming by as well. I appreciate that so much. And remember, clueless, ask Clunis. Have a great day.